Hey everybody, this is Micah here. A lot of people have been asking how am I doing investing in the stock markets and stuff and getting good returns. Some have even asked me to do it for them, but I don't really want to do that. So instead of teaching everybody one by one, I figured I'd make this video walking through my exact way I trade every day. That only takes me 20 to 30 minutes a day on average to get 10% a month returns. And so before I jump into how I do that, some people may not know what an option is, so I'm just going to quickly explain. And we'll use our nifty little paint. So, you may have a house for sale, and you may say that this house is worth, do that instead. Say the house, you're selling the house for $250. If you're selling your house for $250 and I come along and I think that the house could be sold for $300 within the next few months, what you can do is you can sell me an option to buy your house. So you get money. So say you sold me the option to buy your house within 3 months for $1,000. So what does that mean? That means if I'm right over here, I paid you $1,000 for this ability at any time in the next 3 months to buy your house for $250,000. You've already got paid $1,000, and you don't have to do anything with your house. Now, 3 months rolls by, and I don't think I can sell this house for $300. I'm not going to buy your house for $250. You got to keep that $1,000. Now, if 3 months rolls around, maybe it's 2 months, and I think this house is worth $300 or more now, I can immediately sell it for that much. I'll exercise that option, which means I'll force you to sell that house to me for the original $250, because that's what the option says. It's a contract that you have to sell this to me because you sold it at that amount. So it's pretty simple. If you buy the option, you have a choice. You can either act on that, or you can just let that money that you paid go to waste. If you sell, you don't have an option. If somebody wants to buy for what you sold at, you have to sell it at that price. Pretty simple. So that's what I'm doing with stocks, is there's options, and I'll show an example here in a second. But what this does, some numbers, over 80% of options expire worthless. So what does that mean? That means like this. You sold an option to me to buy your house at $250,000 in the next 3 months, so 90 days. 90 days rolls by, there's about an 86% chance, just without looking at anything else, that this house will remain yours, and that $1,000 I paid you will remain yours. That's just how most options work. So, to be an option seller, you essentially become like a casino or a insurance agency. So as we all know, insurance kind of sucks, but the one good thing that insurance is good at is making money, because they'll sell you a policy and you pay for it. All this is selling a policy, you pay for it. But the likelihood of them having to give you what you're paying for is so small, they just keep racking up. Same thing for a casino. The best chance you have to win in a casino is going in and playing roulette one time. It's like 48% chance. And after playing any game at the casino over 500 times, you're virtually going to lose all the money you came in there with. Guaranteed. It's just mathematical. So we want to be the casino, not the casino players. So how do I do that? Do that with options. Now, if you're familiar with options, heard the term before, you've probably heard about the Greeks and the deltas and thetas and blah, blah, blah. And look, really, for the most part, none of that crap matters. Not with the way I do it. You can search that, research it all you want, but the way I do it, things don't really matter. So here I am inside TD Ameritrade. This is a simulated account. I really like TD Ameritrade because of their thinkorswim platform. It's really good. If you're not ready to jump in, that's fine. They have simulated trading. All that means is you'll have delayed data that's delayed by like 15 minutes. But for options, for options, it doesn't matter really. Like, it can be delayed 15 minutes. We're not working super fast. So now I'm going to show you what I do. First thing I set up is a watch list over here. I set it to something like any of those numbers, color code it. The quick chart, I'll color code it. The trade, I'll color code, because what this does, and the chart, I'll come over here to the big chart and I'll color code it. So if there's stocks over here in my watch list and I click on one, everything else is linked. So everything else gets changed to whatever I clicked at. So it just makes it easier to operate. Now what I do in here is whenever you put in a ticker symbol under trade, it pulls up the information, either what it's being sold for at the last, or your options information. I always go in and change the layout, left click, customize, implied volatility, and probability in the money. Really, this is the only one that matters, is the probability in the money. Sometimes I will come in and I'll look for the open interest, which just says, hey, are there people interested in this? If there is, then that's good, because we want a lot of interest. But really, I'm just looking at probability in the money. So what this says is this is the percent chance that this option will be covered. And so let me explain what that means. So if I go to this $3,300 option right here, if I were to buy it, it means there's a 47.02% chance that come February 19th, the price of Amazon will be above $3,300. But whenever I do that, I'm paying, what am I paying? I'm paying $138.30 for that option. So this is, Amazon's the house that I'm thinking is going to go up in value in the next 27 days. This 27 in parentheses is how many days is left until that expiration, when then my contract's no good. I have to think, is Amazon going to go up by more than $138.30? Because what it is the value where you think is going to go above, plus how much it costs for that option. You know, if I did it right here at $32.90, then that's $143.25, and the percent's a little bit better. So that means it's $32.90 plus $143.25. That's what I think it's going to get to. And if you're ever in doubt, you can come down here, right click, and left click on Analyze Trade, then go to Risk Profile. The blue line is the risk profile at expiration, so on the 19th of February. So you can see your break even is at 34.33. Anything above that is profit, anything below that is loss, because you're losing your premium you paid for it. Now what we want to do is we want to sell. So if selling takes away your option ability, like you have to do what the person you sold the option to does, we want to go out of the money where it's more than likely not gonna reach in the given time period. So I like to go around the 30% mark. So I may go out to here and sell, and I don't just sell singles because you're open up to a lot of risk. So if I did this, confirm and send, it tells me my max loss is infinite, because technically the stock can keep going up, and I have a humongous amount of risk. It's going to make me have almost $500,000 to place this one option. Well, that's not very good. Well, it's also I have 10 contracts, so that doesn't help. We'll go down to 1. Look, even then, okay, $50,000 for one contract. That's not very good. Let's look at the risk profile. So Analyze Trade, take the buy off. So what this shows is the inversion, right? So anything past 35.34 in this case is a loss, and it can keep going. Anything below is a profit, and we're maxed out. Like, we're never going to make more than 75.15 as long as it stays below this point. But the likelihood of that happening is 30%. So very low. So what I do is I want to minimize my risk even more. So I'll come in here and I'll sell what's called a vertical. That's all I do is vertical options, like 99.9%. And so what this is I'm buying, or I'm selling this one, and I'm buying the one right below. So there's a spread. So see, my money I'm going to make is less, but my risk is also less. So if we analyze this trade, delete these others real quick so it doesn't confuse anybody. So now you can see my risk is capped. My maximum risk is $355, and my maximum gain is $145. That's not bad. It's about 2 to 1, pretty good. So what I do on top of this is I would immediately initiate a buy. I think I have to go custom. I usually do this on my phone. It's much easier on the phone, honestly. Anyways, you can come in here and mess with the orders to one trigger. So what I'll do is I'll sell the vertical. I create closing, create opposite order. No, I want to. It's so long since I've used the desktop. I do apologize. So can we add? There we go. So where this one, I'm getting a credit, so I'm getting paid $1.45 per share. And I should mention, I forgot, one contract means you control 100 shares. So if you were to buy Amazon, one share of Amazon costs $3,292.23. But who's got that kind of money that they want to risk? So 100 shares can be controlled per contract. And I'm actually getting paid 100 times whatever this credit is, times the number of contracts. So one contract times 100 is 100, times this amount is $145. Now what I immediately do is I come in here and I half this. And then I set, so the TIF is time in force. I only want to get in today if it matches my criteria. But I want my closing order, because you got to do the reverse to close it out. I close it out at 50% of whatever I sell for. And this reduces my risk even more, because right now I'm actually at a win rate of over 85%, making between 15 and 20% on average each trade. And so that is when I negate my few losses, I'm sitting around 10 to 12% returns a month. And so then I just click confirm and send. So I know my max profit is 145, which I'm really going to be hitting about 70, 72. My max loss is 355, but the probability of hitting this max loss is super small. It's like 15, 20%. So I think that's worth it. Go ahead and put it in. It's only going to cost me $355 of buying power, which is not the same as how much you could lose. There's a difference, so you have to watch that. And click send, and it would go through. So now you may be thinking, well, how the heck do I even find which stocks to trade? It's a good question. So on the scan tab, come to StockHacker, and this is what I do. I have 2 stock filters, which you just come over here to the right, add filter, stock option, whatever, and 2 option filters. First one is the last. For me, I don't really, because where my portfolio is at, I don't really like going below $50. Anything traded below $50. If you're just starting out, maybe you set that to $10. Whatever you need to get the stocks that fit your range for where you're currently at. And this can always change. Like I originally started at $20 and I've moved up. Volume, I only want things that trade more than 500,000 shares a day, because that's liquid. Like you don't want to get a good deal on a stock that nobody's buying. Right, like you don't want to get Joe Blow's hardware that 5 people are trading on, because what if it starts going the opposite way of what you want? It's going to be very hard to get out of that trade. So you want lots of people trading that stock. And then for options, I'm only looking for people that have within the next 60 to 90 days, but 60 days caps off a lot of BS that I don't want to look at and have to filter through. And then implied volatility. This is the other portion that we're about to get into that helps with picking. So implied volatility, a market calculation, they think, how much is the stock going to move, and move a lot. I only look at above 70%. because the market's always wrong. They always say there's more volatility than there actually is. And so they price that into the options, which means you're selling something that has an inflated value. So you may be selling a $5 wallet for $20. Baked in there's $15 that, the market's coming back down. Nobody's wanting that. You can just buy that wallet back from later for $10 and you've netted yourself $10. Like, easy. So that's why we only want high volatility stocks. Now, being the weekend, it's probably not going to bring anything up. Okay, I thought so. But I know some from my own research in stocks I'm currently in. So we'll look at Amazon. We'll only look at the 1 year chart. So we can see Amazon's gone almost doubled. Yeah, almost doubled in the past year. And so I put on these studies. Up here, studies, and you add a study, all studies. I do historical volatility, implied volatility, RSI, and the MACD. So this is what it tells me. So historical volatility is like how much has it moved? Okay, right now it's 0.28. Implied volatility is at 0.4, so that's significantly higher. There's a 0.12 spread. That's what I want something that implied volatility is higher than historical, because there means there's room in the options premium, how much you sell it for, to make some money. Because as implied volatility falls, plus time is where you make your money. The RSI is just a simple measure of lately, is it being oversold, which would be down, like down here is oversold, or is it overbought, which is up here? Because as you can see, there's always a correction soon after it gets up or down. Sometimes you have this weird in the middle, which is, you can see with the chart, it's kind of just doing nothing, which is fine. Because the thing is, the stock can do three things. It can go up, as it does here, it can go down, as it does here, or like here, it pretty much goes nowhere. So with the vertical, we're saying, like if I'm doing a vertical here, and I do it at 34 or 3,500, I'm betting, essentially, that the stock's going to go sideways or down. That's automatically 66% chance you're right. Then when you look at like the trends and what it's doing lately, it just increases your chances. And then with having the automatic close set on there, so you don't have to worry about it, and when it hits your mark, you're good. It just makes it really simple and easy. So I'm going to zoom in here a second. So as we see, RSI is not quite 70, maybe coming down. The MACD just kind of helps to determine, general flow. Like, is the stock, trending down, trending up? What do you want to do? So like right here, as I see that the RSI is going down, MACD is going down, I might put in a vertical spread on the call side, which means I don't want the stock going up. I would be wrong because just a few weeks later it's going to go up, and I'd be in trouble. So right now I would not be getting into Amazon because it just doesn't look good. Let's look at Google. All right, Google's looking good. They've popped for pretty much no reason. You can click for some news. I believe it's down here. Oh, that's the order. Oh, live news on the side. And it'll tell you live news related to whatever stock you're looking at. But here, implied volatility is higher than historical. Good. RSI. Let's zoom in. RSI is almost 70, which means it's overbought. The MACD is still going up, so it'll go up again for a little while. So maybe not get in today, maybe wait a couple days and then get in on the contract because it's going to correct. It's going to come back down. Based on all this, like it happens almost every time. So you see it comes up, it comes down, comes up, it comes down, comes up, it comes down. Like it just like clockwork. I don't care what the price is too much. I don't care what the stock is too much. I'm just looking at what's the data telling me. So on Google, if I go to trade Google, because of how overinflated it is, I'd probably do a February contract. The weeklies, don't worry about these. They're not priced well, or at least not as well as others. And you can trade, the gray ones, which are the month only, all the time. Like I can trade February every day until expiration if I wanted to. Um, April's a little far out. I try not to go past like 60, 70 days. So I'd be looking at the February and the March contracts. So I come in here and I'm looking at probability of in the money. And because I've already seen it's a little overinflated, I'm expecting the price to come down. So I'm going to quote unquote bet that way. Alright, so I don't have 30% here. But I'll do the 31.27. That's close enough. So I need to delete these. Again, I apologize. I don't use the desktop too much. I actually do most of this on my phone because it's just much easier and cleaner. Okay, so if it's 31.27%, this is how I actually price them, because the price is important. You can get into the same contract, but if it doesn't have the right price, you may lose compared to somebody else that wins, and y'all can be in the same exact trade. Alright, so that's a $10 spread. Here's the spread. The strike price is $19.80, $19.90. That's $10 times a 0.3127% chance of being in the money comes to 3.127. Obviously, could have done that in our head, but I want to show y'all you can do this for whatever. If it's a $1 spread, $2.50 spread, $5 spread, whatever. Just do the spread times your probability of being in the money, and that gets you close to where you want to get paid for that option. So now with 3.127 in mind, I go and look. It's listed at 4.5. That's inflated because it's already going up. You could set this closer to 3.17 and make sure you get in. You could do 4, you could do whatever. But so then this is how I set mine up. Okay, I think, to get into this trade, because I'm pretty confident, I'm going to do 4.4, and I'm going to change this one to 2.2 because that's half of it. Make sure it's only for today, because after today things change. I don't want in. If I can't get in this stock with these strike prices in either the call or the put side for this price today, I don't want in. I don't want this to be good till cancel, because things will change. GTC says good till cancel. But once I'm in, I want to get out as soon as it hits this price or close to it. Sometimes stocks correct so fast, I actually get better than 50%. So then I would click confirm and send. So this is telling me, even though I'm controlling 1,000 shares of Google, which 1,000 times 1,900 is $1.9 million. I'm controlling $1.9 million of Google stock for only having to need $5,600, which happens to be my max loss. But what I'm getting, this is almost a 1-to-1 because it's overpriced so much. I'm really doing good here because I'm going in at 560 to get 5,600 to get 2,200. So I'm winning 40% of that. Like, that's insane. And it happened, and I have over 70% chance of that happening. So if this was my account, I would 100% take that trade. I'd send it and not think anything of it. I mean, when I check in, I check in about 9 o'clock Central and 2:30 Central, because that's 30 minutes after the market's open and 30 minutes before it closed. It's when most trading happens and most movement happens, and you can see, do I need to do something? Do I need to close early? Maybe there's news coming out, but it hasn't affected the stock yet, and that will go against me. Because calls, what you do for calls is you're expecting the stock to go down. When you sell on the put side, you're expecting the stock to go up. So, this just could have easily, on the chart, been the opposite. If it's down, if Google went down and it's coming up, and everything's the reverse down here, the MACD and RSI is reverse, then I'm going to go in and I'm going to trade the put side because I think Google's going up. And I'll do the same thing. I'll come into the probability out in the money. I'll sell here. So this one is not looking very good. It's a debit. That's odd. You must have some signage problem. 405. Here we go. So this one's better. So this would be 405. So not much of a difference, but the probability is higher that you're going to get caught here because of the correction that's going to happen. And so I just do this all day, every day. I have my watch list that I save. I think I forgot about that. Once you get your scan set up, you can come over here to the middle of the three. Say in your scan query, give it a name, and you can load it up at any time. But then it acts as a watch list, so it's automatically updating, so you don't have to keep adding and taking away from your watch list. So then you just click anything over here, and it all populates for you. But so then I come in, I check on my monitor tab. There's nothing here because there's the simulated trading, but there'll be what contracts I'm in. I'll check, do I need to close some early? Do I need to watch some? Do you know what's happening? Like maybe since Google's popped off, if I have any there, maybe I want to add more on top because I know it's coming down. And keep trading it, several days in a row, but changing which strike prices I'm at. There's a bunch of different things you can do, but that's literally all I do for 20 to 30 minutes a day, and I've tripled my money in 6 months. Like, it's really is that simple. I'm trying to think if there's anything I left out. Yeah, there is. So I'm trying to think of how much do I put into a trade. So on that Google trade, you saw I was risking $5,600. And all that matters is how many contracts. So say you're starting out with $500, because everything is percentage based. So this will work small, medium, large account. It doesn't matter. So if you're starting out with just $500, first off, $500 after 1 year, $1,500 after 2 years, assuming you put nothing else in, 3 years, 4 years, 5 years, 6 years. Like, you see, like, the compounding. It actually would be more than that. But just using 3 times is a good conservative investment. So if you have $500 that you're starting off with, I never put more than 3% on any one trade. So for $500, that's $15. So you may have to go down to those $5, $10 stock ranges and find a contract that's only going to take $15 or less to get into. And I start there. And that's per trade. But of my $500, I never risk more than 80%. I try to stay around 75. I never risk more than 80. So I have roughly $15 divided into $400. So I'll have, if this was my account, I started with $500, I'd have somewhere around 25 to 27 different trades going on. And the reason being is you're diversifying your trades so that no one trade can blow up your account. And this works going up. So, like, if you're at $50,000, I would risk no more than $1,500 per trade, which then means you're times 0.8. So you're not risking more than 40,000. Actually, do the math correctly to show everybody. So I would have no more than 40,000 risked total, and again, no more than 1,500 on any one trade. So now that I'm at over, this is what I did to go from 30,000 to over 100,000. So now what I'm roughly doing for the next little bit is no more than 3,000 per trade, which means of 100,000, I'm not putting in more than 80,000. Now that's, rough estimates. I'm not going to get right at 3,000. I'm not going to have right at 80, and I'm not going to recalculate when I'm at $104,200. What's 3% of that? Like, I'll stay at 3,000 for a while. Because it's just as it goes, the amount goes up. I'm just getting less risky because the less of my total is on each trade. Then probably at 105, 110, I'll reevaluate. All right, what's the new limit? Don't go above that limit. Because the thing is with stocks, especially options, if you just have rules and stick to your rules and don't let emotions drive you, then you're good. I stick to a lot of. You also got to find what works well for you. Like, I stick to a lot of tech stocks and defense stocks and things that I know well from my own world, because I automatically, without trying, keep up with the news for them. I got a sense of how well they're doing and everything just because I naturally do that. I'm not going to go and do options on wheat or real estate or or J.C. Penney's or retail or something. I don't know, because it's going to be harder for me to keep up. Not going to be as informed, and more likely to lose my money. So that's about it. Sorry that this has gone on a little longer than expected. If you have more questions and I didn't go over it, I try to get everything, but just let me know. I'll be glad to help y'all out however I can. Thanks. Y'all have a great day.